Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Dollar index is actually shuttling lower here. That's mostly because of expectations of potential economic weakness here and rates going much lower.
I mean, it's to be expected. This is a patient that was very sick.
It's the worst day for U.S. equities since 2020, I think June of 2020. Basically got to go back to COVID kind of days.
India's got a lot of, it's a resilient economy. It's got a lot going for it, and I think should be able to weather the storm reasonably well.
The Nifty Bank is ticking higher, about 0.5% up on the Nifty Bank.
Uncertainty is always the certainty, and more so in this market nowadays.
What we really need to keep in mind is that what is the impact of all of this on end user demand?
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category.
6% of a decline in the overnight markets, and that has been the biggest single-day decline since July 2022.
The Nifty is now just below 23,000. Now, Bernstein highlights the near-term risk is a potential recession in the U.S. or global economy that can delay IT spending.
They are significant, and you've seen this come from markets. You've had a major repricing of growth prospects.
The Nifty is still down around about 300 points, still trying to hold on to that level of 22,950 is for the index.
Well, markets are down, and they are responding with some amount of severity. We're down 1.5% on the Nifty, but the broader markets are selling off much harder, and it's a tough global screen that we woke up to, and that's essentially going to be the focus. What next as we head into the weekend? We're coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I'm Prashant. With me, my colleagues Surabhi and Reema. Guys, hi. Afternoon.
Hi, I can just say thank God it's Friday, right? 1 hour to go.
And I hate to say it, that both of us are in similar colors. I mean, I think we're bleeding red along with the market. But what a session, guys. I mean, look at the way stocks are falling. Tata Steel is down 8%. Hindalco is down 8%. So, global decline. I think yesterday we were, feeling a sense of relief, maybe a little bit of bravado. But 24 hours tells us that we're not disconnected with the global financial system.
And today's fall is in sync with the global market.
Yeah.
So it's not that today we're outperforming. It's not relatively we're looking better.
Actually, we are doing even better. Even now we're doing better.
That's over 2 days, but I meant today.
That's an eternal optimist speaking. Wonderful.
Or pessimist, because if you're not as worse off, then maybe there's more to come. Because we're down only 1.5, and Wall Street was down 5-6. Asia is down. By the way, Japan was down 10% at one point. 10.
Yeah.
And then there was a sharp rally into close.
Yeah.
So then it closed with a cut of about 2.75%.
So there was a very sharp move.
But
anyway,
Europe is 1.5 down.
Absolutely. So yeah, I mean, the tariff tumult continues in that sense. And it's Nifty, which is down 1.5. Mid-cap index is down 3. The small-cap index is down 4. So in a way, I mean, it's like, large caps, if you go by safety, right? Nifty, mid-cap, small-cap, and then in that sense, I mean, maybe in a twisted way, it makes sense. Nifty, of course, the level, we are exactly at the 50% retracement of the rise that we saw. This level we put out for the last 2 days, 22,917 is that level. Okay, now we've broken that as well as we come in. But it's not a big break. It's about 20-30 points lower than that number. 22,896 is where we're at. The next support, I mean, 38 got broken today, 50 has gotten done. The next one is 22,692, 22,700 roughly. That is a 61.8% retracement of the full rise from the lows of March 3rd to the 25th of March. And below that, then I guess it's the March low itself. But we'll see. Take it step by step. And of course, the close over the next hour will be important. Nifty Bank is a big relative outperformer. It's down only 0.25%. So, it's HDFC Bank, Federal Bank, ICICI Bank, Axis, Kotak, PSUs, not so much. Now, Asian stocks are lower. China, by the way, is shut. Asia is lower. Treasuries rallied a little bit more. I'm talking about US Treasuries. Trump says he will relent, but he needs to see something phenomenal being offered. That's the word he used. It has to be phenomenal. That's the problem. What is phenomenal? How do you get out of this? What's the, in a way, is there an exit out of this? Is there a way to get out of what he's imposed? I think that is the basic problem right now. He said, of course, that pharma tariffs are on their way. So we'll see if something comes over the weekend. It kind of builds in that risk. And later today, we have the US jobs data, which is especially important because so many high-frequency numbers have all showed that the economy is already slowing down. So in that sense, this will be something to watch. And of course, Powell speaks as well after the jobs data at some point in the US session. So lots to track. Rima.
Powell speaks tonight.
Tonight, yeah.
Oh, well, that's going to be important. For the Nifty, as Prashant said, below 22,900. And with the fall today, we're below the 20-day moving average, which is, again, closer to 23,000 and below the 50-day moving average. The key rates from frontline Europe will come up for you on your screen, and they're down close to about 1.5% and opens, extending the sell-off. Metals are hit the hardest today. So the Nifty Metal Index has a cut of about 6.5%. And individual names, 8.5% on Tata Steel, Hindalco 8%, Vedanta down 9%. Brent crude prices continue with the slide and now below $68. In the morning, we were closer to 69, maybe slightly lower than that, and now 67.66 on Brent crude prices. And other commodities too are under pressure. Mid-cap IT, that's lost about 10% over the last two trading sessions, yesterday and today. In fact, more than that, maybe even inching towards a 12-13% kind of a knock on a Coforge, Birlasoft, Persistent. Very few stocks in the green, but I think top honors to HDFC Bank today. Finally, good deposit numbers quarter on quarter.
I think beyond the deposit numbers, it's just like what can you buy in this market which will not be impacted too much by anything that's happening global facing? Where can you hide for cover? Pharma is not that sector. FMCG is not that sector. IT is not that sector. So you're left with very little choices. But financials and pristine, clean financials are the only stocks which perhaps are offering that sense of safety, coupled with the fact that the Q4 numbers have been pretty decent for most. Bajaj Finance about 1.5% on the higher side, HDFC Bank, ICICI Bank. So financials are becoming a bit of a safe haven. However, I mean, a lot of commentators you've heard on the channel since morning have been saying that they might not necessarily be market leaders, poster boys for a new bull market, but at least they are offering safety right now. Anyway, when you talk about losers, and even if you're looking at the broader market, I mean, the decline on a couple of these large stocks, either they're large caps or large mid caps, it's staggering. Like I'm saying, global facing names, commodity names like Vedanta. Vedanta is now down 9%. Hindalco, Tata Steel, we've discussed. Look at Oil India, smashed 8% lower. So Nalco, commodity stocks are absolutely getting pummeled. So that's one clear takeaway. Stock like Bharat Forge, I mean, clear exposure to the US market, though they said, Mr. Kalyani told us that they have plants in the US and they're going to try and ramp it up very quickly to see if they can produce more out there. But that's the sense of damage that we're seeing. PG Electroplast, 8% down. PG doesn't even have exposure. We spoke to the company this morning. They don't have exports right now. And it's all very domestic facing, room air conditioners, etc. But people are just taking the money and running for the hills, at least for the timing. Look at the mid-cap index, down 3.3%. This is not a market where anyone wants to show bravado, and maybe for good reason. Okay, so let's straight away get to the strategies. How do you navigate a market like this? We've got Mitesh back with us. Mitesh, good afternoon. Tough, last 24 hours. What would your advice be now?
Yeah. So, I think, I was slightly cautious on the Nifty, saying that below 23,100, we might see more declines and a reversal could depend on the Bank Nifty. In the early hours, the Bank Nifty was positive, but then it's also turned negative, and therefore, the Nifty has sustained below 23,100. Now it's opened negative targets of 22,800. We are practically there, and then 22,600. So good chance that we can possibly see 22,600, 550, 570 come into play. And that's where there's a gap and some kind of a pivot, which was made on the 7th of March. So with that kind of scenario, I think, buying would not be advisable. In fact, we've been suggesting people to exit long positions. I have a sell on REC with a stop at about 407.5. Target of around 380, about 388 can be looked at. The other one is Piramal Enterprises PEL Limited. That's also having a negative setup on the hourly charts. So sell here as well with a stop at about 975 for targets of 930.
Okay, all right. Mitesh, thank you very much for that. Which was the last one, Mitesh? Sorry, missed that. The last trade?
The last trade was pyramidal finance.
Okay. By the way, any thoughts on, look at what's happening with, and you know, Manisha will be coming up and joining us in just a bit. Look, any thoughts on Vedanta? It's the biggest volume-led loser. It's down 10%. Look at... Yeah.
Vedanta, exactly the
8, 9,
price
10%.
damage on metals.
Tata Steel is down
Yep,
8-9%, and I mean, just whacked down. Any thoughts, Mitesh?
So, to me, I think, there is clearly some kind of a negative setup which has happened in the charts. In fact, it actually started the decline yesterday, and then today was a gap down, and then we've seen follow through. Prashant, the only hope is that on the 28th of Feb, which is the weekly closing of Friday, we had a closing of 394, and before that, I think way back in August 24, we had similarly some base building around this 390 mark. So it's getting close to that, but the setup suggests that even if you get a bounce back from 390, that should be used to exit anything around 410, 415, and there's a higher chance of us breaking below 390. If that happens, then 365, 360 should be the minimum target.
Okay, the Nifty Metals Index is down 7%. That's wow. I don't remember 7% fall. I think you'll have to go back a long time to see that. I think the last time we would have seen something like this is on the election day last year, which is 4th of June. That's what we have now. Dilip Bhatt is with us. He's founder at Pedigree Advisory. Dilip, thanks very much. Let's just start with the metal space. What's going on?
Good afternoon. I think maybe the metals have taken it on their chin. But if you ask me very frankly, it's markets just across which has taken it on the chin. Maybe metals have taken it a little more. I think this uncertainty which possibly was there, and a lot of people which I believe were bullish on the metal sector, I think suddenly after all this, now probably they have downgraded their expectations. But my own sense is that it's still very uncertain times, very difficult to generalize today's movement and make a secular call. So I would say that this uncertainty is reflected across most of the sectors, maybe a little more, little less. I will say that, for example, pharma, nothing has been said on pharma, but just because the president just made a statement that he's looking at pharma also in terms of levying the tariff, and you see the kind of reaction that is happening. So I would not read too much into this particular fall of metal. I would say let's look at the market and the sectors across.
Okay. Dilip, hold that thought. We want to talk a bit more about the metal sector, put the spotlight on how metals are faring. Manisha is now joining in. Manisha.
Well, thank you for that, Rima. Well, it's a second straight day, and we're looking at very sharp cuts coming across commodities, and I'll put metal in focus right now. The tariffs have come strongly, huge for China, which consumes and produces nearly 50% of the world metals there, and that's exactly the reaction that we are seeing right now. Also, ahead of all of these tariffs, US had shipped in a lot of metals also. So, it really is about buy the rumor and sell the fact kind of situation that we are seeing coming in for metals at this point in time. I'll start with copper, where we have seen very sharp declines, 8% down in this week, and it's come off 10% from its all-time highs that we saw in the previous week itself. With this kind of a decline, we are trading at a 1.5-month lows in case of copper on LME at this point. Aluminum is down 5.5% over this week, and if you look at this year as well, aluminum now has turned negative for 2025. It's down 5.5% for the year as well. Aluminum currently is trading at a 9-month lows. Zinc is another one, down 5.5% for this week. It's down 10% for this year now, and that one also is trading at around 9-month lows. So very sharp cuts coming in for the metal prices for the last couple of days here. And it's not just about the base metal prices. Steel is now trading at a multi-month lows. You have iron ore prices, which are down nearly 6% this week. That one is trading at a 5-month lows as well. Silver, which is now counted almost like a metal, is also seen very sharp decline. It's down 8% in this week, and silver is now trading at a 1-month lows as well. So the decline clearly coming in across board, but the major of sharp cuts really coming in for aluminum and zinc. These two metals for the year now have turned into negative, which was positive until previous week. So clearly, these are the two metals hit the most.
Oh, absolutely. And it's a global risk off, right? I mean, people are just moving away from risk assets, whether it's stocks or even some of these commodities that have, run up quite a bit. And it's just a quick pile up into U.S. Treasuries, which explains where the yield is 3.9 on the U.S. 10-year. So we know where the money is going. It's all going into U.S. Treasuries for the time being. Aditya Velekar, Senior Research Analyst at Axis Securities, is with us. Manisha, thanks very much for that roundup. Let's take this forward with Aditya. Aditya, so given that this is not about demand supply, this is a market moving entirely on sentiment, what would you advise people to do with listed metal stocks? I mean, Tata Steel, Hindalco, 9-10% of a decline coming in. So for anyone who's got a trading position open, what should the course of action be?
I guess, yes, the risky assets are taking a backseat. So it's a risk of sentiment. And what we have seen is that post the Feb 12 tariff announcement from President Trump, there was a rush from exporters to push the metal to US to take the advantage of higher physical premiums in US. So that arbitrage window is now getting closed as the actual tariff announcement is materializing. So that's why we have seen that the LME copper, aluminium, and zinc, they have withstood the initial tariff announcement and the prices were strong. But as the arbitrage closes down, so there is no momentum or no incentive for traders to push the metal to US. And that has led to a sudden decline in the LME aluminium prices and other base metals since last couple of days. So that's number one. And number two is now the question is arising on the medium-term demand and how that will pan out, because the supply chain, because of these reciprocal tariffs, that comes into the question, because most of the Southeast Asian countries where the reciprocal tariff is imposed, and also China. So how the metal will flow ex-US market, that is also one of the reasons where the demand picture in the medium term is coming. And domestic US demand is also come under question. So all these factors indicate that if the demand dynamics ultimately gets dented, then the prices, commodity prices, have to reflect downwards. So in general, we have seen in last couple of years that the metal cycles are not moving secularly upwards. The cycles have become shortened and volatile both. That is because the major consumer, China, the property sector is not picking up and it has stagnated. So we have to play in a very short volatile cycles. We have to capture the cycle at the bottom when the valuations are very lucrative and at the bottom. And we have to exit when the valuations are expensive. So now we foresee some further downside from here. If the stock prices correct maybe by 10%, another 10%, then the valuation becomes attractive. And then once again, we can think of entering the cycle. But as I said, the cycles will be very short and volatile both.
10% lower for both ferrous and non-ferrous from here on?
So recently, the non-ferrous prices were strong, and those have corrected since last couple of days. And the prices may correct further. So it's slightly speculative to point out the quantum of correction. But for ferrous now, the situation, the ferrous space has already taken a lot of hitting. And we have seen that the steel prices have kind of bottomed out. And the steel mills have taken price hikes post the 12% import duty, safeguard duty announcement. So steel mills have taken price hikes to the tune of 1,000 to 2,000 rupees as recently as last week. And the positive point for ferrous is it is slightly localized commodity as against non-ferrous. And also the coking coal prices have in the range of $170 per ton. So the kind of spread for ferrous, which is a difference between the prices and the raw material, that is coking coal and iron ore, that spread is kind of preserved and is improving. So ferrous at this point of time looks okay as compared to non-ferrous, because for non-ferrous now the fall in the price trajectory has just begun, and if the demand destruction happens, then the prices may come down further. So that's the entire view.
Aditya, main issue is this last point you mentioned, right? I mean, fears of demand destruction, overcapacity, and demand destruction on the other side. That's the basic issue. That's the basic fear going ahead.
That's the basic issue. And the narrative was that non-ferrous metals, they have a structural demand tailwind because of the electric vehicles, because of the renewable energy and all those developments. But with Trump coming in, and a lot of those narratives are getting sidelined, or there is a lot of uncertainty on those narratives also. So, and there is we don't have to forget that China is still producing a quantum of metal, which has to, and its exports are still at a very high level. So it has to divert those exports to somewhere else. And with the protectionist policies coming from Europe, US, and elsewhere, South Korea, so there is a lot of question mark on where this metal will flow. What will be the stockpile, and where that stockpile will flow. So all those things is weighing on the metal prices.
Okay, got that. Aditya, thank you very much. Good speaking with you, and quick view there. Dilip is still with us. Dilip, thank you for waiting. So what should one do now, Dilip? I mean, from a if one is active in the markets and not a SIP kind of investor, then you just sit back. I mean, what is there to do? But if you're a do-it-yourself investor, what should one do?
So I would still say that if you still have you're not booked profits, you're still fully invested, and you have some fresh inflows, I think there is no need to commit really in this particular market. Possibly a small amount of steps that you can do in this market. I would say that, as we all know, that market certainly does not love uncertainty. And, though the tariffs have been announced, I think it has only accentuated the kind of uncertainty that we're talking about. Too many moving parts, a lot of kite flyings happening. And today, I mean, it will be, if you see the fall in the commodity price, especially the oil, is supposed to be good news for us, because every $1 movement is equivalent to almost about $1 billion, $1 of oil movement. So I would say that one should wait and watch. One did not be in a hurry. This fall in oil price up to a particular point will help us. But beyond that, then there will be talk about a lot of demand destruction that will happen, the wealth destruction, sorry, that I was referring to. So, what I will say that, yes, wait for a while. I think markets have been in such a great shape in the last 3-4 years. No need to commit over next couple of days in a hurry.
Okay. Any single stocks look attractive, Dilip? Anything you've done?
So I will say that maybe the infra space looks pretty interesting from an overall point of view. The concern still being that government is a reluctant...
L&T, Dilip? You're talking about L&T?
Sorry?
You're talking about L&T or any what segment in infra?
No, I think infra space I'm talking about, infrastructure. So within that, I'm talking about that overall infra space looks pretty interesting. And Larsen & Toubro, I would say, and maybe down the line, something like a Nagarjuna construction also would look good from an investment point of view on a longer term basis. So I would say that this space still is a little more neutral to the overall scenario that is being played out.
Okay, now got that. L&T, Nagarjuna. Did we talk about pharma, Dilip, at all today? Any thoughts there? Bit of a flip-flop from yesterday. Road ahead?
I would still say that the pharma sector still looks pretty good and interesting. So if it's falling, one should certainly think about investing in this particular sector, because I think that's one industry where we are going to find demand inelastic as compared to the prices. And so, in spite of the fact that the tariffs may come, but I think the US will still have to import because that's the health. So I would say pharma sector still looks pretty interesting despite the fall today.
Got that. Dilip, thank you very much for joining in. Enjoy your weekend. We need to get into a break for now, but we'll come back as we do that. Here's some good news for all our viewers, because India's business news leader is now just a click away. We're introducing CNBC-TV18's all-new app. You can get access to all our articles, financial world updates at your fingertips. So don't wait. Download the app now from the Apple Store or the Google Play Store, or you could just scan the QR code on your screen. Welcome back. The Nifty Pharma Index is down over 4%, reversing all of the gains of yesterday. For the week, the Nifty Pharma Index is down nearly 3%. Vinny's now joining in. She's been analyzing the impact of impending tariffs on the pharma sector and what they could be. Vinny?
Afternoon. So obviously yesterday what we were talking about is that pharma was exempt from the list as of now. They were reviewing those documents. Now we have commentary that's coming from President Trump. He's saying that he will be announcing tariffs in the near future and it's not the distant future. So we could expect it sometime soon. And he's also highlighted that the tariffs which will be coming this time on the pharma sector will be something that we have never seen before. So does that mean that we could see higher tariffs? Are currently India 26%. So could it be higher than 26%? Now we have analyzed some bit of a data. There's a note that's coming from CLSA highlighting the impact of different tariff rates. Firstly, let's talk about the 10% rate. Now for Dr. Reddy's, currently obviously the exposure that they have is somewhere around that 40%, more than 40% in that 40-50% range. So then if Dr. Reddy's does see an impact of 10% tariff, it would be 12%. Aurobindo would see an impact of 15% in terms of EBITDA. This is for FY26 and FY27 if this is 10% tariff, and Zydus would also see an impact of 12%. When you see a 20% rate, it would come in at somewhere around 23% impact on Dr. Reddy's. Aurobindo would be 30%, Zydus would be 24%. Now, if you look at it in terms of the higher rates, that would be 30 and 40%. A sharper impact would come in, obviously. And for Aurobindo and Dr. Reddy's, Zydus, it would be in the range of around 35-36, and Aurobindo is the highest, 45% impact on that front. 40% is obviously very, very high impact that we're watching out for. So that is a major impact that comes in for these companies specifically. Why? Because the exposure that they have to US is somewhere in the range of 45 to 49% to 50% approximately at that level. Now let's talk about the other companies, that is Lupin, Sun Pharma as well as Cipla. For Lupin, Sun Pharma and Cipla, the exposure is below 40%. It's in somewhere around 32 to 40% in that range. So Lupin would see an impact of 11% if it was 10% tariff and 23% if it was 20% tariff. Sun Pharma 8 to 16%, a bit lower in terms of impact, while Cipla for the 10 and 20% would be 9 and 17. 30 and 40% would be higher. Now, the main reason that CLSA is highlighting is that these companies see a high risk. Generic players specifically will see a higher risk coming in, and overall Indian companies contribute around 46% to the generic savings in terms of the US healthcare system. So that is a big amount and a big chunk that goes into the US healthcare system. And what CLSA believes that even if tariffs are imposed, we will be able to pass it on, and that is why they think that there will be a bit of a shift that we could see in terms of the share coming in across the globe, but surely important to watch out for in terms of the impact and how much will actually be passed on.
Okay. All right. Got it, Vinny. Thanks very much. So now we are, again in uncharted territory, uncertain territory with respect to pharma. Vivek Paul, Head of Portfolio Research at BlackRock Investment Institute, is with us now to take some questions. Vivek, thank you so much for joining in. Not an easy market at all to be in, right? Because we're just living in greater and greater uncertainty. As one commentator, I think, said that this is maybe only the beginning of uncertainty. But what do you make of the whole global stock market rout? When can there be some hope of perhaps stability?
It indeed is a very uncertain time, and you're right, and thank you for having me on. So I think the thing I would say relative to the framing you had is maybe we're approaching peak uncertainty. And I think that would be an important point to make here. Yes, there's been a lot of, day-to-day things have been shifting and changing, but I think over the course of the coming months, we would start to see some of that smoke clearing, I guess, in terms of the fog that is out there at this moment in time. By all means, I think this could get worse before it gets better. We should be very aware of the fact that there are some material changes happening to the global markets right now and a wide range of possible outcomes. But we still have a view that when you're looking at a little bit further, about 6 to 12 months from here, we'll be past that peak uncertainty and we'll start to see an environment whereby the US assets, for instance, can start to outperform again. But absolutely right now, huge uncertainty, and we could get worse before it gets better, because what we've seen in the last couple of days is a stagflationary shock.
Vivek, you said that perhaps in some time from now, US risk assets could start performing well again. Can you just expand on that? Because what's happened is obviously the US equity market's back is broken. It's taking down all global equity markets along with it, and there's a general sense of risk off. So what do you see ahead? When do you see some semblance of stability returning to that market? Because, I mean, we don't know when this is over. We don't know the new trade alignments, the final tariff lines, tariff rates. Nothing is clear right now.
It's very true, and indeed, the US has underperformed other regional stock markets year to date for the reasons you've mentioned, because of the huge uncertainty that is there. I guess one of the things that I'd say though is that markets had been anticipating looking at the measures in the last couple of days as a sort of a milestone with regards to how we look at the future kind of opportunity set. And my point is that what we've seen announced are presented at least as ceilings. They're presented at least as an upper bound of how severe, I guess, some of the imposed tariffs could be. And there's room for those to effectively come down. There's room for the landing zone to be less than the ceilings that are currently put out there. And my anticipation here would be that as we get through the next couple of months, some of the uncertainty that has, as you say, rightly been plaguing the stock markets is likely to be behind us. It's not to say that everything is entirely clear, but we've got to remember that US assets have underperformed year to date. And despite the fact that actually the underlying fundamentals for some of those assets hasn't materially changed, right? The overall sort of US consumer remains comparatively strong. We still have some of the best tech companies in the world in the United States and trading now at cheaper multiples than they were just a short period of time ago. So again, just to be clear, by no means am I saying that there is not room for this to get a little bit worse in the near run. But once we start looking a little bit further ahead, the point I'm making is that that's when we should be behind the peak uncertainty.
Couple of months, that's what Vivek is saying, that this peak uncertainty phase also could last maybe a couple of months.
The thing is, maybe we'll get Vivek's thoughts as well. The reason markets sold off in this unhinged way last night is because the tariffs were unhinged. It goes back to that how the tariffs were calculated. If they were reciprocal, markets were prepared, but they were not reciprocal. They were, in a way, out of thin air, 52%.
Yeah.
The problem is it was calculated basis, say India's surplus against US is $40 billion. US is saying wipe that $40 billion clean. That's never going to happen.
Yeah.
So there is no way out. That is the problem, right?
Yeah.
I mean, if there is a way out to solve, you can negotiate, but what is the negotiation? What are you negotiating on?
Yeah.
Because you're saying we don't want this deficit. But there's no way to do that. It's not going to happen.
Yeah.
Not just with us, with anyone else. So I think actually
negotiating down, I take your point. I mean, negotiating down tariff barriers is one thing. You can argue that there should be no tariff or non-tariff barriers.
Correct.
But wiping out trade deficits is a separate matter.
Which is what they're saying.
Yeah.
So actually, theoretically, we may be one headline away from market stability. Theoretically.
Yeah.
I mean, they may come and say, well, this is an error. I don't know what they can say. But the point is, that is essentially the issue. That how do you, there's no path forward to negotiating out of this in the way this has been calculated is arbitrary. Vivek, would you agree with that?
Well, I think one thing that's very true, and I sympathize with the points you're making, is that up until now, markets have been guessing as to what the true underlying goals of this are. And I think, as you've mentioned, there have been different things that have been put forward. The point I'd make, though, is that there is room for that negotiation. I don't anticipate the negotiation to end at the status quo we had prior to the election of this administration. I think it's clear that the floor now is the 10% sort of effective tariff rate that we're talking about, that global tariff rate that we've been talking about. So it is a different environment that we're in relative to the past. But the point I'm making is that the markets are reacting as if, to some degree, the ceilings that have been announced are likely to be the landing zone, and that's the direction of travel of the risk sentiment. The point I'd make is that certainly with a country like India and its relationship with the United States, I think there is room for the landing zone to be a little bit different to what the current announced tariff is, and I think that's the point I would make when it comes to the
Vivek, I think that point is taken. So India's weighted average is about 9.4%, right? Let's get specific. So you say, okay, we're going to cut it down to 2%. Does that bring down our claim tariffs of 52% down to the 26% down in the same 26, which is the effective, the so-called discounted tariff? Will it help bring that down to 10%? Can we be sure?
I think...
And that's the problem. How do you... Yeah, sorry, go on.
Sorry, Prashant. Sorry, I didn't mean to interrupt you. I think the point I'd make here is, though, that this is the there are, exactly for the reason you mentioned at the outset, there are multiple dynamics here in terms of what the US is trying to achieve. And the point I would make is, for instance, rather than enacting higher tariffs on India, it could be that if India sort of responds with lower tariffs on United States imports, then effectively the landing zone looks a little bit different. So the point would be that because of some element of ambiguity around the motivation for some of this stuff, I think there is this room for the landing zone to be different to where we currently are.
Okay, Vivek, we'll leave the conversation here for now. Thank you very much for joining in with your thoughts and insights. Let's move. Yeah.
I just one, that headline there, right? We're one headline away from stability. What will, and now you think about what will prompt that headline. Will, because so far they've not bothered about, and we were discussing this in the morning, that Trump he seems unperturbed by the US market fall, 5-6% falls. Yeah. Another 5% will do it. Another 10% will do it. Because since he's taken over, he's not once talked about how proud is he that the Dow is rising every day, which he used to do when he took over the first time around. So, but it's kind of difficult to imagine that he's completely abandoned stock market health as a priority, although that doesn't seem to be top. It doesn't, seem to be making the first cut. So it's, it's variable, and I think the market, if it continues to sell off like this, I think they'll have to offer a path. I mean, the other parties ready to negotiate, but the point is, how do you negotiate, I think, is the...
When your starting point is trade deficit, that too only goods trade deficit, as commentators have been making the point, I don't think this is inadvertent. They don't want to have such large deficits with trading partners, but they've forgotten the other side of the equation. There's goods and there is services. And in services, I mean, the US has been doing a phenomenal job, which is whether it's digital tech, whether it's, of course, financial services, but they're only looking at, half side of the equation. When it changes, if it changes, we don't know. But it's something that we have to look at. Speaking of IT, let's just go back and take a look at IT stocks. I think, most of them are still down and out. But of course, the headlines have been now overtaken by metals, which is a far more weaker space in the market. Till the morning, we were bothered only about IT.
But it's still down 8% in 2 days, and now 22% lower for the Nifty IT index on a year-to-date basis. A quick run through of what brokerages are saying now. Bernstein says in the near term, the impact is going to be uncertainty in IT spending. Therefore, the impact on budgets, will tech budgets come down, and will this hurt growth? The worst case scenario is a global financial, the GFC kind of a crisis, when, there was a deep, widespread recession, and Indian IT companies suffered. In the quarter when there was the GFC crisis, TCS reported a 6% revenue decline on a quarter-on-quarter basis. Accenture's revenues fell by close to about 13%. Not that Bernstein is saying that we're going to have a similar GFC kind of a reaction and an economy, but they are saying that FY26 could be flatter or lower growth compared to what the street was earlier anticipating. They prefer Infosys in the large caps, Coforge in the mid caps. They are completely avoiding they're underweight auto ER&D names like LTTS and Tata Elxsi. JP Morgan is saying, when will IT bottom out? And again here, this is the bear case scenario. No growth in the top line and no margin expansion. To that, they've added the bear case PE multiples, and they've arrived at a price for TCS, which is about 5% decline from the current market price. On Infi, about a 4% decline from the current market price. And on HCL Tech, about 12% from the current market price. So basically for TCS and Infosys, perhaps the bottom is now closer, maybe just about 4 to 5% from current levels. Though on mid-caps, high-growth companies with high valuations like Coforge and Persistent, their bear case, the lowest target price for these companies could be 13% down for Coforge, Persistent about 25%. So that gives you perhaps the bottom to work with for IT.
We're looking forward to those IT conversations next week.
Well, you'll be a part of it.
There'll be. I think we'll spend 5 minutes talking about the Jan to March results and 25 minutes talking about
the uncertain environment.
See the
visibility.
The mastery that most IT managements have, with full respect to all of them, is to be able to make everything look like business as usual. They're rarely shaken or stirred. So I want to see what the two of you come up with in your conversations this time with this environment. Should be interesting to watch.
And it's, TCS is on Thursday.
Which
is a market holiday.
They're always unperturbed. The world can turn upside down, but Infosys, TCS, always unperturbed. So
You didn't try to move the interview.
I tried.
Okay, all right. Time for a quick... time for our segment, D-Street Chatter. Nimesh is now joining in with what he's picking up from people he's been sort of speaking with, and generally the mood out there. Nimesh, take it away.
Hi, Prashant. So finally, it looks like India is joining the global sell-off. So we actually was not the part of it yesterday, but today it looks like we've joined the party on the sell side. And the bigger pain is in the broader markets. The mid-cap index is down over 3%, small-cap down 4%. The breadth is weak, and a lot of individual names have seen very sharp sell-off today. So that's a bit of a jolt from a sentiment point of view, that the broader markets have collapsed very sharply in today's market. Within sectors, metals, pharma and IT are the worst performing sectors. But within that, my sense is that the biggest sell-off is happening in the IT stocks. So for the second day running, I understand there is aggressive selling from larger institutions in the IT names. And clearly, from a flow perspective, it looks like there is a shift happening from IT to financial. So that's clearly a shift from a flow perspective. On the upside, I've been talking about 23,800 as a very strong resistance. Now on the downside, 23,100 could be a bit of a near-term support on the Nifty. So watch out for that levels. But clearly, if there is a global risk on, I guess India too will be part of it, and there could be further pain in the broader market stocks.
That's already happening from today, Nimesh. But have you picked up anything on individual stocks?
Well, despite all the sell-off and all, there are a lot of stocks which are buzzing, and there is a lot of news as well. So the first stock on my list today is Sammaan Capital. Very rarely we talk about this name now. It's like a forgotten stock almost at 52-week low, not much traction as well. But now I understand there could be some corporate development in Sammaan Capital very soon. Potentially, there could be some top management reject, which could be interesting to track from here on. So that's the first name. The second stock is Polycab. Within the wire and cable names, this is one stock which is under pressure, largely on back of selling pressure. So there is delivery-based selling, and I understand a leading domestic mutual fund is looking to trim the stake there in Polycab. So that's the reason why that stock is under pressure today. Third is a couple of pharma names. While we flashed that Trump's comment on pharma and the stocks, while that has recovered from the intraday lows, but there is selective buying in pharma names at lower levels. So Sun Pharma and Lupin both stands out in terms of small buying, but there is buying interest from large institutions in the pharma names. And the last is Bharat Forge. We spoke about the Morgan Stanley downgrade. The stock is under pressure. There is selling as well from large institutions. And there was a Morgan Stanley tactical sell as well. So that's adding pressure on Bharat Forge in today's market.
Okay, all right. Interesting names there and an interesting chatter as Nimesh is picking up. Nimesh, see you at 3:30 on Editors Roundtable. Well, we'll take a quick commercial break here. We get you some short-term trading ideas on the other side. Stay with us.
Welcome back. So as we are getting into the final leg of trade, there isn't much recovery. 22,900, this is practically where we are at. Maybe you can say a little bit of bounce, 20-30 points in the last 15 minutes. Let's take some final thoughts with Mitesh. Mitesh, indices as well as any final stock ideas.
So I'm going with a negative view on the indices, given the fact that the Nifty has kind of given a minor breakdown. So I have some BTST call. That's the first one is Tata Chemicals. That's STBT cost. Tata Chemicals is in STBT with a stop at about 819 for targets of 800. And Voltas is the other one, which is in STBT. Keep a stop at about 1310 for targets of 1280.
Okay, all right. Mitesh, thanks very much for that. So some trades are coming through there. Bharat Forge and Tata Motors are in focus here. Some brokerage notes and downgrades. So it is here with details. So over to you.
So while most of the auto companies are under pressure, but two companies that are severely under pressure are Tata Motors and Bharat Forge, and it's on the back of two downgrades that have come. For Tata Motors, CLSA has maintained its outperform call, but has removed from high conviction stance, and it has cut target to 765 from 930, and says basically it has removed from high conviction because of two main reasons. First, expected US slowdown, and JLR, because of that, JLR volume is expected to come down by 14% in FY26, and it believes that EBIT margin in FY26 and FY27 will come down to 7%, and in FY25 this margin is going to be at 9%, while JLR had said earlier that it maintains its guidance of 10% EBIT margin for FY25. Also, it has cut FY26 EBITDA estimate by 15%, but expects JLR to remain free cash flow positive. Now coming to Bharat Forge, Morgan Stanley has downgraded the stock to equal weight from overweight, and has cut target to 1170 from 1366. Also, it has lowered EPS estimate by 15% for FY26 and 11% for FY27. And the rationale of the downgrade is first, US slowdown, and the second is the tariff. It believes that it will offset non-auto business and defense order gains that company might have got over the next few years. And it says that US exports currently forms 35% of stand on top line, and the truck, which forms 19% of the top line, already has been been under pressure, and this 25 to 27% tariff on auto and non-auto products is going to impact margin by 200 basis points in the near term, and valuation as per Morgan Stanley appears full at current levels.
Thank you very much for that, Sudarshan. Now let's get some global opinion. Kate Moore, CIO of Citi Wealth, talking about Trump's tariff announcements, the impact on markets, and what investors should do in light of this uncertainty.
That effectively we don't want to be adding to risk right now. If you have a portfolio that is fully invested, we're going to sit tight and think about being a medium and long-term investor. But if you have cash that you were looking to deploy, the uncertainty factor, whether it's in bonds or in equities, was too great for us to have a really convicted call. Price levels are really interesting, and we'll be watching some of the technicals. We want to be thoughtful about when we re-enter the market or we think about adding to risk. But I would also note the uncertainty factor is just starting. I mean, one of the things I kept telling the team going into yesterday is April 2nd is not going to be a clearing event for the market. Earnings are just going to be starting. I'm watching really closely how companies talk about what they expect for the balance of 2025, even ex the tariffs, because we know that there was some slowdown in momentum.
Okay, let's get in Sudeep Bandyopadhyay, Group Chairman of Indie Trade Capital, on the show now. 12 minutes to go for markets to close what's been quite a horrendous trading session, 1.5% down in the benchmark indices. But it's the fall in metal names. It's a waterfall kind of decline in Tata Steel, Hindalco, Vedanta. 8-10% of their market cap erased. What would you advise here?
Well, I'll definitely advise people to remain on the sidelines, keep watching. Fundamentally, both Vedanta and Tata Steel does look good, but I think a couple of things have happened together. One is, of course, the fear of massive demand destruction. And secondly, I think there was a lot of tactical movement of metals into US before the tariff announcement. So obviously, the prices went up a little bit more than what was supposedly, rational. And that correction is happening. But I think primarily it's a demand destruction fear, which is leading to this massive correction in metals. Let things settle down. Let things, whichever way, find the balance. It's too fluid a situation to really comment on whether to buy metals or not. I think it's better to wait and watch.
What about IT, Sudeep? Afternoon?
Well, IT, I think I was just hearing your commentary a while back that the We normally wait for the management commentary on the future. I think this time we will only wait for that because the numbers don't matter anymore. What they're going to say about the future is what is most important. But having said that, I'll also say, irrespective of whatever they say, I think it's very difficult for anybody, any human being, to predict what's going to happen in the next 3 to 6 months. The way US administration is moving, it's extremely difficult to predict what's going to happen tomorrow. So, how can you predict 3 months, 6 months, and 12 months? So, yes, we will watch what they say, but I think it's extremely difficult to predict anything, whether it's us or anybody else or the IT company CEOs. So, we'll wait and watch. The possibility of a slowdown in US is real. We already kind of suspecting that the jobs data today, which is revealed, will start showing the effect of that. Chairman Powell's comments will be there after that. And if there is a slowdown in US, IT budgets will be under pressure. There is absolutely no doubt about it. And Indian IT companies, by and large, derive 50% of their income from US. So obviously there is going to be pressure. Irrespective of whatever we think or wish, the pressure will be there, and it's better to be careful now.
Sudeep, the fear is that what if the IT companies don't guide? They defer their guidance, companies like Infosys and HCL Tech, and that means the uncertainty lingers on. Even if they guide for saying 0 growth, 2% growth, you can make the EPS adjustments and move on. But if they don't guide, they defer their guidance, citing lack of visibility, then the uncertainty lingers for another 3 months, and that could be a scarier proposition for investors in tech names. But we'll slip into a break on that note. Stay on, Sudeep. We'll come back with more on the markets.
The baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back. 5 minutes to go for markets to close. The mid-cap index is ending with a cut of about 3%. Nearly 5 stocks declining for one in the red, but some of them are higher today on decentish volume. So Kaveri Seeds 12% up. VIP Clothing, that's got a gain of about 8%. TARC, TARC 5%. Kitex Garment has a gain. Marico came out with their numbers yesterday. The stock didn't react considering the uncertainty. But today, Marico is up close to about 2.5%. And then you've got a couple of these financial names. So PNB Housing Finance and Ujjivan. You've got a Karur Vaisya Bank. These are stocks higher in trade. And generally, telecom has held up pretty resilient, whether it's Bharti or even in Indus Stars, with a gain today. In conversation with Sudeep. So Sudeep, what have you done in the last 2 days? Have you bought anything? Have you sold anything? Or are you just telling your investors to sit tight?
Well, we haven't sold anything. In fact, we've been advising investors to be just sitting and watching what's going to happen on 2nd April. I think in hindsight, it was not a bad decision. And at this stage, we are still watching, honestly. But my belief is that some of the sectors and some of the stocks, particularly in the large cap space, does look good. And, we had maintained this view for quite some time that every fall is an opportunity to buy a Larsen & Toubro, a Reliance Industries, maybe an Ultratech, maybe an NTPC. So these large cap stocks, which are not really that exposed to these tariff tantrums and focused on construction, infrastructure, and domestic or West Asia, I think does look good from a long-term perspective. Somebody trying to build a long-term portfolio makes sense to buy these, taking the opportunity of this correction.
Interesting names there. But all, of course, large caps in that sense. By the way, do you believe as you head into April, and this was a question even before these tariffs were announced in such a great, these big tariffs were announced, that question still lingered, that is there another dip which was pending in April? And many did believe so even before these tariffs. I don't think anybody saw these tariffs this high. So just asking you that now, Sudeep, what's your sense?
Absolutely, Prashant, that was the question in our mind as well. But I think everything got blown away with this set of tariffs, and the correction, which we would have probably seen a little bit of correction here and there, did come. But I must mention to you that we were positive actually on the domestic internals. Look, inflation has started coming down. And that gives RBI a fantastic handle to keep cutting interest rates. Now, this does augur well for the economy and the markets. So we were banking on this rate cuts to kind of propel the market and the economy ahead. And probably that's going to happen anyway. Of course, this entire trade war fiasco, trade war issue needs to be examined much more detail. And things haven't settled down in this front yet. So that, of course, is a big uncertainty. But otherwise, assuming the monsoon predictions and monsoon is good, I think things should start improving. Q4, we are not expecting anything great. It will be by and large in line with the muted expectations we have from corporates. But going ahead, I think things should start improving. That was the prediction. Now, this entire tariff thing needs to be understood, and entire calculation needs to be remade for arriving at what's going to happen, what's impact is going to happen on Indian economy and Indian market. That needs to be seen. But I think time for that has still not come. We'll wait and watch for a few more days before carrying out that exercise.
No, point taken. The strategy which you described, not to do very much, right? What can one do? Just watch this market whipsaw up and down. And I think that point about large caps is well taken, Sudeep. Thank you very much for joining us today. Have a restful weekend, and we'll chat again. The market, of course, is down sharply. Is there some recovery? Maybe, yeah, there is some recovery. I think, let me see what the low was today. The low was about 22, the low was 22,857 was the low. So we broke below that 50% retracement level, and we have managed to come back above that level. So that 50% retracement in 22,917, and we are at 22,915. Can you believe it? It's almost there, exactly there by close. We'll get the adjusted close, of course, and maybe the numbers will change a little bit because there's been a sharp recovery which has come through as well. We have the Bank Nifty, which of course is the clear winner, not just today, but for the week as well. For the week, it's flat. For the day, it's down only 0.16%. Mid-cap index and small-cap indices on today, that is Friday, sharp cuts, but for the week, down between 2.5%. Because earlier this week, they had some gains posted as well. So that's the overall picture as far as the broader indices are concerned. I'm just going to quickly take you through two indices which I think deserve special mention. IT index should come up. 9% knocked off in the last 2 days. Actually, for the week, it's down 9. Bulk of it has come, of course, the last 2 days. And the metals index down 7.5%. So, this is 7.5 this week. So IT and metals really took it hard. And pharma, of course, it was complete flip-flop. Thursday higher, Friday lower. So the Nifty Pharma Index up on your screen, 4% lower. So yesterday the Pharma Index ended 2% up. It's lost double of that today. So that's the overall picture. Well, I think that gets us to a close as we wrap up this edition of Closing Bell. That's it from all of us here. Goodbye. But don't go anywhere because we're going to jump across to the roundtable. The Editors Roundtable program comes up next in just a bit.